Trades NQ back with another video. Today's video is going to be about liquidity, guys. Let's get into this. Let's do it. All right. I got a couple of notes here on the side. Liquidity are pools of area where buy side and sell side orders are resting, and they are created by traders entering longs or shorts, and they provide fuel for price to move. That is why liquidity is so important, and that's why I'm a liquidity trader, and I target these draws of liquidity because we know price wants to move there, because we understand a fundamental understanding on how the market works and on how order flow works and as well as that the market needs to move towards these draws of liquidity to move the market. Awesome. Let's understand what buy side and sell side is. So let's say if anybody was here, right? If people were longing here, right? If people were longing here, right? There people were longing, right? This is a draw of liquidity if people were longing. This is going to be sell side liquidity. This was right here. We could actually write it down. This is sell side liquidity. Awesome. Sell side liquidity right here. Here people are trying to long. This is sell side liquidity. Alrighty, this was buy side liquidity. Let's see if we can make it a little bit larger. This is buy side liquidity. Anybody that was shorting here. And this is the orders that you're basically targeting. You see how we target it? And this is the orders that you're basically targeting. And then this is going to be buy side liquidity. Awesome. Buy side liquidity, sell side liquidity. And this is where we know the market targets we know that the market targets these points of liquidity. All right, we need to understand how it's formed. Where liquidity is formed, it's formed above swing highs, buy side liquidity, swing highs. This is a swing high. And also below swing lows, which is here, swing lows. This is sell side liquidity. And then also equal highs. So technically speaking, these would be kind of like equal highs right here. I mean equal lows. And then let's see if I could target one out. Maybe these are almost equal highs here. But whenever the two sides are touching, kind of identical, like equally, that's an equal highs. And the same thing for the bottom when they're equal lows. Cool beans. And these are obviously support and resistance levels as well. You could think of it as this way, if it's a higher time frame, like if it's a higher time frame, let's see if we could find a higher time frame. And let's restart. Let's move my notes out of the way for a second. Let's move that there. Just for a second while we do this. Perfect. So if you're thinking like this, right, this would be a form of resistance right here. Right here. Here would be a level of support. This is a level of support. Whenever we kind of bounce into here, this range, and this range, we know that we want to go up. We tend to go up here, here, a level of support, we touch, we go up. And then we also know that this is a level of resistance right here. Here, we tend to go down. As soon as we kind of go in this general vicinity, we go down. We go here, go down, go here, go down, here, go down. You see, go here, go down, here, go down. Then we go here, and then we're on our way up. And it will look like we're breaking this level of resistance. But here. Let's get into, nope, this one. Let's get into here. How price moves. So the big four things that you need to understand about liquidity is liquidity is formed, price makes liquidity, price takes liquidity, price returns to the equilibrium, and then the fourth one is imbalance is mitigated. I'm going to explain these in very detailed ways. So liquidity is formed resting buy and sell orders accumulate at highs and lows. So we make these forms of liquidity right here. We're creating these, correct? Creating these swing highs and these swing lows. And then liquidity is taken. So when we go here and take this liquidity that's here, usually people, so if people are going to short here, right? They're going to take these liquidity, the people that have hanging orders or the people that are in this trade, they're going to take this liquidity and either move from it or take it and go and distribute it elsewhere. Then price returns back to equilibrium. So whenever we move out of a range, like roughly out of a range, and we take some sort of liquidity, usually we'll return 50% towards that move and make a new range in between there. So what ends up happening is we'll go like this, right? We'll go boop, 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 and so forth. You know, we usually tend to go 50% back into the range that we were in the range that we previously made. So if we go up, 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 we usually go 50% into that, the equilibrium. In which they call as fair value. Imbalance is mitigated. So basically, if price tends to go back to a higher time PD array, which is a fair value gap before continuing. So if it's like this one's a bullish 4-hour fair value gap or PD array, means price usually ends up going here, touching into it, and then respecting and going higher. That's what that means. Balance is mitigated. Or sometimes we even fully disrespect it and then continue to go up. So what ends up happening is we kind of go here for a little bit, and then we end up displaying higher. But yeah. As well as what does liquidity does. Liquidity is price is drawn to liquidity and it acts like a magnet. So we know price wants liquidity to move because it's like fuel, like in your car. So if we know that we need to, before we make these moves, we need fuel. So we're going to end up taking some swing low. We'll end up taking some swing low and then displaying higher. Stops are often taken first before the true move unfolds, and liquidity defines directional bias. It shows the draw. Basically, liquidity, the prices draws towards liquidity, and I think we have a really good display of that in the 1 minute time frame. Let me see if I could find it today. Right, we have consolidation or accumulation, then you have manipulation, and then you have distribution. You know, you have the delivery, you have where price actually wants to go, and this is called the power of three. And there's a lot of ICT videos about it, but this is just a little video that I wanted to show you guys. So this is consolidation right here. Here's consolidation, manipulation, and distribution. So you got. So just to know, it's called the power of three, and price tends to do that. Price tends to sweep some sort of liquidity to go higher. So it's started sweeping these this liquidity here, as well as touching some higher touching these previous day highs and previous month's highs, and then actually giving the actual delivery higher. But yep, thank you guys for watching. This is a good video. This is a video of liquidity, and I have reminders, guys. Liquidity, stop, run, equilibrium, expansion. And if you don't understand where liquidity is, you understand where price is going to go. So if you understand where liquidity is at, then you understand that price needs to go to there, and then you could better successfully increase your. Yo, it's Sammy Trades NQ out. Hopefully you guys enjoyed the video of liquidity and understood a lot. Thank you guys for watching. Join the Discord down below, and please like and subscribe. Thank you very much.